right, and we're back with IPO season again. It's 876 Invest. I'm Nicholas Dundas. I'm joined here with Schaunn-Anthony Thomas, and we're going to go through a very exciting Edufocal prospectus today. And this prospectus is so comprehensive and detailed. Again, we always encourage that you read the entire prospectus, but this one is so detailed. You need to sit down and read through the entire prospectus. However, we'll still go through some points that really stood out to us, the typical things we look for at the start of or analysis into these companies, which include like the risk factors. Obviously, you have to do financial analysis, understanding the overview of the company, looking at some outlooks and prospects for the company, and we'll get right into it.
So Edufocal as a company is they're a training platform. They have two different business segments. They have Edufocal Learn, which is where they gear towards actual in-school education. At this time, they're only offering PEP level education, but there exists the room for them to potentially grow into more, as well as the Edufocal business side of things, which is where they go into different businesses to provide industry-leading training. This also, I think, has a lot of legs to run into the future. There's lots of things that could happen with both of these lines, and I think Edufocal is an interesting business. All right, so in this offer, we have an invitation where the company is offering us to purchase up to 129 million and change shares for a subscription price of $1. Important to note is that 38% of these shares are reserved. 35 million of these shares will be reserved for key partners in the reserve pool, and another 13.2 million will be reserved under a lender's option agreement, which we'll get into a bit further, which leaves 80 million shares for the general public. So that means that for the general public, you're only going to have an opportunity to raise up to $80 million. The ways in which you can apply for this IPO are through Mayberry's new IPO platform, where you'll visit mayberryinv.com, and then you'll just see a pop-up which will tell you to apply for the IPO, and then you can follow the instructions there, or through JMMB's Moneyline platform, which is a very simple procedure, as those who have previously applied for IPOs with Moneyline will know.
So this prospectus is dated and released on the 17th of February. It's slated to be open on the 3rd of March. And typically, we treat the opening dates of IPOs like closing dates. It's also important to know that this IPO is the smallest that we've seen this year. The last two IPOs, JFP and Spurtree, were both closed before the closing date stated in the prospectus. So we have all the more reason this time to treat this IPO like the opening date, like the closing date. It might be best for you to sort out the account applications, IPO applications before the date. So we move on to the use of proceeds. They are planning to raise approximately $130 million. And that will be used for three things. One, the transaction cost of listing the company on the Jamaica Stock Exchange, junior market. Number two will be $42 million will be used for the repayment of short-term debt. And we'll go through the debt breakdown a little later in the presentation. But it's important to note from now, the key point, the interest rates on all the short-term debt are extremely high. I think it's only one of like 4 or 5 facilities that have a debt, the rate below 10%. And the remainder will be used for expansion in new markets, including acquisition opportunities. And for a company like this, it's a tech company. There's going to be significant spending on research and development, especially in its growth phase, which is where we are right now. So the use of proceeds clearly outlined, and I think it's good to see for a company like this.
All right, so now you know my favorite part already, guys. We're going to touch on some of these risk factors. Now, in this prospectus, they went very in-depth with their risk factors, much like the Spurtree IPO prospectus. They have, I think it was over 15 different risk items. So I'm definitely going to encourage you to read this prospectus and take a look at all of those risk factors for yourself. Dundas and I are just going to touch on a few of the major ones we found here that we think would be a bit more useful for people to understand some more about. Like the first one is the Data Protection Act 2020, risks relating to that piece of legislation. So that is a legislation which deals with consumer data protection. So when we have to give our data over to even like an Edufocal or other types of companies, Facebook, Instagram, and all of those companies that we share our information with, it just codifies how they operate with that data. They can't just give it away willy-nilly. It goes and says, all right, you must protect it in these ways. These are the circumstances in which you can share the data, etc. So once this law is implemented and properly being enforced, it may or may not lead to some changes in the cost relating to the protections that Edufocal has to take. So you may have them having to spend a bit more on certain cybersecurity costs, You may have them having to keep the data in specific ways, which may mean they have to set up virtual infrastructure that they do not have yet. So there are just some potential things relating to that. The next major risk we thought we should highlight was the risk relating to changes in technology. Now, as a young company in the tech space, Edufocal is going to have to be nimble when it comes on to new technologies. And as we know, technological advancement will never stop. 2008 was the first smartphone, and 2022, 5G is coming worldwide. So, I mean, like the speed at which technology changes is very, very, very fast. And so it's going to be interesting to see what kind of changes will come in the space that Edufocal plays in, as well as how that requires them to be nimble and adapt to this environment.
And as a risk, I don't think it's something that would make me afraid of the company, not confident in the company's capability to do something like this. If there's a change in technology, I do believe that Edufocal will be able to adapt quickly. The reality is, though, that for operational expenses, it's something that we have to consider, because for a business like this, typically in tech, especially for young tech companies, there's heavy spending in research and development. And in a case like this, if there's supposed to be change in technology, which likely will be the case as the world advances, there's going to be a need for Edufocal to spend significantly on increases in technology usage and advancement.
The next risk is the risk relating to cybersecurity. Now, we touched on this point earlier when we mentioned the Data Protection Act and that risk. However, this is important to note outside of that as well, because Edufocal as a technology company, even if they are not required to do certain things by the Data Protection Act, they do run the risk of hacks. And we've seen big international companies like Sony get hacked. We've seen NCB locally get hacked, and even Victoria Mutual, we saw recently, had some
data breach,
client information being leaked. So it is definitely a major risk that they have to take serious steps to curtail, because security, the security of your information is something that I don't believe anybody should ever compromise on. And as long as they are going to provide a digital service, there's going to be a need for cyber protection of my data. So I think this risk is something that Dundas has pointed out, they're going to have to spend money on, especially as technology changes, the way how people try to break into these things change, backdoor viruses, different hackers going in, simple little things like your website. That little HTTP is a part of a protection on your website that you see. So I mean, there's lots of things that we have to look at when it comes down to cybersecurity and protection of people's data, especially given the ages of the children who are on the platform
currently. But yeah, we'll get into that.
So another risk is the risk related to intellectual property. Now, Edufocal's platform and software is proprietary, so they run the risk of copycats. People who come out and say, "Oh, you have spent all of this money to build up this platform, and now that we understand how it works, we're just going to replicate it for cheaper." Now, Jamaica has an office that regulates these things, Jamaica Intellectual Property Office. I do not see them mentioned by name in the prospectus, so I'm not sure if it is that they're registered there. However, I must say Edufocal does say that they have reviewed all of the software and their platform and licensing relating to it, and making sure that either they are allowed to use this software or that the platforms and things are indeed proprietary. So I'm not sure on the actual protections against that, but it is good. It's comforting to know that they at least have done the reviews necessary to ensure that the platform and the software that they use is safe. The final one out of the prospectus that we wanted to take a second to highlight was operational risk. Now, this touches on systemic risk, which that relates to accounting errors. It touches on legal risk, compliance, reputational risk, employee risks, whether it be employee making errors or employee theft or those kind of things, as well as other forms of fraud and criminal activities that could just arise from the nature of the operations. Employees are employees. You never fully know 100% about anything. Accounting is a field that changes yearly. There are new standards introduced and old standards retired. They currently have no litigation, but there could always be someone claiming that their platform is not proprietary, or there's many different things that can just arise throughout the day-to-day operations of the business.
Right. So these refer to things that happen as a result of the nature of the business, and so this is more of a general risk that you'd see in typical companies of a similar nature. But it's very important to understand and consider what these really may be able to, how they may affect the company's operation, especially for something that is tech based. Materially, I think the manual system failures, computer failures, those things are what I would see as the biggest issue, especially in Jamaica, where we have a when you're supposed to compare the teledensity, all right, the overall availability of technology and Wi-Fi in rural areas, those kind of things. So the access to those things may impact the company's ability to operate. Uh, Internally, however, things like computers shutting down, outages, those things can have operational. Those things are operational risk, things that will impact company's operations. But I wanted to also mention a risk that came to my mind when I was thinking about the company overall and how COVID may impact the company. We'll touch on something like this later on down in the when I get into the financials. But the first thing that came to my mind, I have to say it, when I saw a company like this coming to market was, and I consider the variability of income. And obviously, a tech-based education or training platform would have benefited from COVID because we had to make a change to digitize most things. And I was initially concerned that the company's revenues would be impacted negatively when we revert from that kind of lifestyle. When we go back to more face to face and less things are online, the company would have a slowdown in revenue because less students are online. But there are places later on that you'll be able to see why that really isn't a concern because the company has treated with that issue already. That risk has already been mitigated.
I want to disagree with that point where you said they've already mitigated that risk. I mean, I see some mitigation, but I don't know if I'd go so far as to say the risk is already completely mitigated. Edufocal's business line, as we can tell through the average revenue user, which, as Dundas said, we'll get into those kind of things a bit later down. But we've seen that the users of Edufocal have been spending more money on average. However, I still have concerns about the long-term nature of that. We don't know what the types of clients are that make up these businesses. With inflation at such levels of highs, consumers may be choosing where to spend money, whether it be at a business, depending on the type of business. If it's a discretionary spending business versus something that you definitely need and things are 10% higher, you may not go and do that kind of discretionary spending, which may lead that company to have less revenue, which means they cannot afford to spend the same amount on training. And so you may not end up getting as many clients on the business side of the thing. It's not something that I'm super concerned about, but I do want to keep watching it, and I just don't know if I'd be willing to say it's fully mitigated as of yet.
I mean, the risk of its longevity, I think, is something that we can somewhat predict because of the nature of things, the nature of the system. So I agree with the point that as a result of inflation and the impact of inflation on discretionary spending, companies and individuals would want to spend less on things that they do not see as necessary immediately. But
Mhm.
key point, necessary. What if it is necessary? For example, financial institutions have a requirement that the employees have to keep abreast with AML KYC policies. They have to understand how to deal with certain things, and those things are offered in course format annually, I believe. And there are other lines of business that require frequent certification, consistent revision of the material, and that will allow for the longevity to be a factor. And in this case, you wouldn't really. So, for example, if they're supposed to partner with BOJ, if they're supposed to partner with any or all financial institutions, they would once they're offering a product, and we do already believe that their product is a good proprietary product, then going forward, you would be able to see longevity of that revenue. You wouldn't necessarily have to see them onboard a new bank each quarter, each year, but
Mhm.
the AML KYC courses will have to be done annually. There's also things relating to government. Well, we know PEP and CSEC is every year, and there
Mhm.
are other things to consider. That even say I start with at PEP, when I get to CSEC, if I can relate my success in PEP to my Edifocal attendance, I'm going to do the same thing for CSEC. I'll do the same thing for CAPE. I'll do the same thing for tertiary education. That's a possibility. So the longevity of it, I think it's more of an opportunity than a real risk, and that's why I say it's mitigated. I won't say it's fully mitigated because there is a risk that it won't take out the way we expect it to. But the way it is structured, I really think that there is a lot more potential than than it is a risk for it to fail.
I mean, I do agree with you that there's a lot of potential there, and that, as you said, the KYC things, and I think that's why the type of client is going to be very, very important to that business side of the Edufocal. What types of clients do they have on, and what types of training is it that they're going to need, as well as they could maybe seek applications to do some certain software training. So, like accounting softwares, there's only so many that you're going to see people really use. For the most part. So you could have those kinds of things. But the student point that you brought up is something that I did want to touch on before we moved on from risk, which is like, okay, you may, if they do launch back the CSEC and CAPE things, and if there's a tertiary operation as Edufocal grows, that would all be beneficial. But as of right now, where it is only the PEP level on the learn side, well, your students only do PEP once. So every year you're looking for a new set of parents to get these kinds of things. I mean, of course, you could have people enroll from grade 4 come up, or you could have parents with multiple children. But for the most part, you're going to just have a child coming in and sitting to do this course. So I think the business side, even though I am skeptical on the right now side of it, I think it's a good move to diversify the revenue of Edufocal.
So see, we've gone into the outlook of the company, where you can see them
Yeah,
going. I think we'll just keep on that vein. Um,
sure, sure.
the business side of things. I mean, we'll be able to verify what we're saying now with the numbers as we go into the financials. But the business side of things has seemed to already offset the possible reduction in revenue from the learn, right? I do agree with you. Good point that you do PEP once, and after PEP, if you don't have other things to offer going forward, then you would not be able to retain those clients, and then you'd have to. I mean, if even if you retain them, you wait until it's next 5 years when you're ready for CSEC. However, in
Yep.
September 2020, they started the full learning. It's not just guidance for PEP or specific examinations. They have like full like school.
Yeah.
All
Fix my
right,
phone.
so we're gonna go through the 5 years financial performance of the company. So now we can look at first. We start with $6 million in revenue, and in the 5 years, we're now at $102 million. So our first profitable year would have been the year ended December 2020, and that's the midst of COVID. So this, as I said before, it started the presentation, that we're now in the growth phase, and this is where the company would definitely need to keep up the momentum to maintain the revenues as high as they are now. I think that the growth in the last few years has been great to watch, especially as it relates to how it is based. And we spoke about the risk of the learn versus the business, and how it would be likely that once schools start being reopened and there's more face-to-face interactions, then we would have less online school, and as a result, the company's revenue should take a hit from that. I do still believe that the learn side of the business will have a little bit of difficulty as it relates to the retention, because we'll have more face-to-face, but it's more, as again, there are other things that they have done to mitigate these risks. There have been an introduction of like after school, after class kind of things. It's not just the full day of school. It's not just training and lessons specific for PEP. It's going to be not just a day-to-day thing. It's going to be after school thing. There's going to be
As well as some gamification of the platform to make it feel more interactive and
Mhm.
make students themselves want to be logging on to the Edufocal platform and changing and make it not feel like school. I mean,
Right.
that's,
Right.
that's something good that they do as well. So just before we move off of the 5 year financials, personally, I don't like when I'm conducting analysis, especially given the type of boost that Edufocal would have gotten from COVID. I personally would discount 2020 um, in my analysis and calculations. Just because, as we keep talking about, we expect as the schools open back there to be some of that revenue to come off, and so I mean we're trying to figure out where we lie before. But it is still impressive nonetheless, because even over the 4 year period, 2016 to 2019, you see where the revenue has grown from $6 million to $26 million. So it's still a massive growth story. I just would discount some of the growth that we see in 2020 um, due to the rush online as a result of COVID. You see where they have continuous investment into themselves, negative gross profit, because as Dundas keeps mentioning, he's a technology company. They do a lot of research and expansion and development, and that's a huge spend for them. Especially if you look at tech companies overseas, you always hear how long Amazon took before it became profitable and all of those kind of things. I don't expect Edufocal to be any kind of 20-year unprofitable story. However, the point remains, when it's technology, there's a lot of investment into the platform that you have to do before you start to see the returns. And when the returns come, they come at exponential rates.
I was about to jump in and say that this is a very scalable business, and they're getting to the part now where you'll be able to start seeing exponential growth. I mean, it's already evident with the revenue growth, and as you say, it can still be discounted, but regardless, it's still exponential growth. And another
Yeah.
another important thing that's here on this financial statement is in 2020 we see the finance cost increase by 7 million from the previous year. That is that's a very very important thing to look at, especially because the use of proceeds of this IPO is to clear short-term expensive debt,
They've been getting some crazy interest rates.
crazy interest rates. So in the wake of this raise, provided it is successful, we're supposed to expect there's an expectation that the finance cost will be largely eradicated. There will still be long-term debt, but the long-term debt arrangements are more favorable as it relates to interest, and that's the key component of finance cost. The interest rates that they're paying, interest expenses that they're paying because of high interest rates. So that's something that is very very key to look at, especially for this particular IPO, because this IPO is to clear off a lot of the, if not all of the short-term debt. So that is going to translate to a reduction in finance cost, which we can see at this point is about 80% of profit. So if it was supposed to be eradicated, just for argument's sake, if it was supposed to be completely wiped off from this financial statement, we'll be seeing an 80% increase in profitability for that year.
Yep. And I believe finance cost is something that is going to be important to watch with Edufocal going forward, based on the technological nature of their business. Us in Jamaica, we like physical things. We like secured debt. We like, you don't pay me back, I can take your car, I can take your house. There's some asset that I can levy a charge against. We like those kinds of things. When the majority of your business relates to software in this local environment, you are gonna naturally pick up a higher interest rate than somebody who has more physical things to levy the charges against you.
Mm-hmm.
It's just very difficult for financial institutions to recoup off of digital assets. You'd have to transfer ownership, and depending on what exactly the asset is, there's many things that the institution would have to go through. So as a result, they will always tend to get higher interest rates. And that's important because we are seeing what our central bank is doing, where our current policy rate is now at 4%. And we have seen indication from commercial banks that they plan to raise the pass-through rates to consumers in the coming over the coming months.
Mm-hmm.
So that's something that I think is going to be important to watch. Edufocal, if the listing is successful, will always retain the ability to use the market as opposed to another financial institution to raise their own funds. But it's going to be an interesting line item that I'm going to definitely keep my eye on going forward.
So again, for this particular video, we're not going to go too in depth with the analysis of the company. I think the company's principals have done an amazing job in breaking down everything that we're supposed to see in the prospectus. What we will, however, highlight is the things that do stand out, particular line items that will receive additional focus. For example, intangible assets. Schaunn mentioned earlier, as it relates to security, how relevant it would be for, well, the impact of having a company like this, how they will go about raising it, because banks will they'll be more reliant on security when it's tangible. You can take land as collateral, you can take buildings as collateral. And when it comes to intangible assets, that's something that it'll be structured differently. In this case, majority of the company's non-current assets will be intangible. That relates to the software, that relates to proprietary information. That's the courses that they have licensed. That's the platform itself. Those are things that comprise their intangible assets. The PP&E would also include, regular fixtures and fittings, computers, equipment, those kind of things. Important to look at. We'll go deeper into some of the particular line items when we start talking about the September 2020, the period ended September 2021. because it's more recent. This is December 2020. We're now in 2022. The receivables primarily because of new engagements with new parties, so new school,
Ministry of Education.
Ministry of Education. So that's largely an amount due to that new business. As a result of COVID, of course, we'll have some collection issues. So we would naturally see increases in payables there. Uh, we can look at the increase in long-term borrowings and the size of the short-term borrowings. As again, we mentioned the need for companies like this to spend heavily on research and development. And in this particular case, we can see that the big increase in long-term borrowings. We know that the company was forced into overdrive for expansion because of how fast we adapted to this new digital age as a result of COVID-19. Another thing that is key to look at, as again, we'll look at the short-term borrowings because this is what the IPO is for, to clear high interest short-term borrowings. So we will move to the 9 months ended September 2021. And we spoke about this earlier with the changes from the B2B to the B2C to the B2B. That's business to business versus business to consumer. In this period, we can see a significant increase in the revenue, and that's largely because of the implementation of B2B.
All right, so here for the 9 months ended September 2021, you'll see where the revenue jumped from 77 million to 107 million. No, that is very, very key, even though it's just there like, oh yeah, that's $30 million growth. That's just very good. And I'm like, cool. The important part to note is, as you'll see when we get a bit further on, their paid users fell drastically. It was a serious drop, even just between 2020 and 2021. Now, granted, that is to be expected. As we said, there was a lot of pull forward with the people being on the Edufocal platform due to COVID-19 and not having any alternatives. So seeing the paid users fall is not surprising, but seeing the revenue grow $30 million in spite of that fall is very impressive. It goes to strengthen Dundas's point that he made earlier relating to the business to business side of things, where they have Edufocal Business and Edufocal Learn. Edufocal Learn, as we know, is the PEP part. But Edufocal Business, we have seen their growth, as we have seen average revenue per user also shoot way up. And that is why this revenue growth is more impressive than anything. Because even if you were to hold the revenue constant, even if you were to just say, we got all of the same money that we got from education last year and no new money from education, you'd still get $30 million new dollars from a business line that you didn't fully have up and running properly at this time last year. And there's lots of runway left for that to grow. I mean, companies do training all the time, all the time. So it's going to be very, very interesting to see how that side of the business affects revenue going forward.
And this breakdown of the revenue, to look at why it happened, is crucial to see how far this company can go, because what would allow revenue to increase? An increase in price, or persons are spending more money on the platforms. And since we know that we have less users on the platform, what it means is they're spending more money on the platform despite no price increases. So what that means is it's a result of more products, and more products B2B. So I give it 100% to that growth. That growth is attributable to the implementation of the business to business side of things, and that I think has, as Schaunn said, a lot of legs to grow and run. So that's something that I'll be looking at keenly going forward. However, despite the significant increase in revenue, obviously it will be accompanied by an increase in administrative expenses based on line of business. We've mentioned a trillion times that this type of business, young tech, research and development, hiring new talent, that's going to cost a lot of money. So we will expect to see administrative expenses and operating expenses increasing as they are in their overdrive growth phase. Again, based on what this offer is geared towards, raising capital to clear debt. Finance cost is going to obviously be one of the most important things to look at here. We see a jump from 4.9, basically 5 million, to just over $13 million finance cost as a result of high interest debt. That is the purpose
Yep.
of this IPO, to clear that kind of thing. So yes, you see a loss here of 1.4, and we can't say for certain that taking off the debt will naturally translate into profitability going forward, but it is definitely a key factor. It has been something that has significantly negatively impacted the company's operations, and if we're seeing that coming off going forward, then it's fair to assume that the company will be more profitable going forward.
Agreed. I think it just, I mean, even without profitability, it allows them to be more nimble. You'll have more cash to disperse to do more things, whether it be reinvest or pay a talent a bit more to retain them. Not to say that they pay talent badly. I have no knowledge of that. But just as an option, there are many different things you could do with the additional money. If you had 13 million more dollars that you didn't have to pay out, or even let's say you halved it, and so you had just about $6.5 million more to play around with. It's a lot of money for a company at this size. They could do a lot for their business with that kind of money. So it's gonna be very, very interesting to see finance costs come down.
And I think the overall picture of things should be taken with a grain of salt. Usually, I would look at it, you can't look at it as bad corporate management to say, oh, they took a lot of high interest debt, and they weren't maybe, who knows how hard they tried to get debt as cheap as they could. But the reality is the company was in, I don't want to say it was a desperate phase, but desperate for the right reasons. Because this was a point in time where the company really had probably the biggest opportunity they'll ever have to hit into their super overdrive phase. Like half of the world went online, and at this point in time, they didn't have a choice but to aggressively raise capital, and they really had to. So at this point, I mean, yes, we can see that the finance cost has hurt their profitability, but it was a necessary step, which is clear in the revenue growth. And that's something that I expect to continue to grow going forward. And it's just the territory, the kind of business, the time of the kind of economy we're in, the timing overall as it relates to COVID shutdowns, being online. It was a time in their business cycle, that they didn't really have much of a choice but to be very aggressive with raising capital overall.
Raising funds overall,
Raising.
because they did several private issuances of funds and private raises as well. So I mean, we can touch on those things a bit later. But
Hmm.
they really did. You're right. They tried very, very hard to make sure that this opportunity did not leave them um, without any benefit. So many people know their name now. There are so many people who were exposed, whether or not they're still using it. At least they know the name. You may come off, and then you may find that your experience is not so good in the regular extra space or pep classes or anything. Your child may prefer the online version, the gamified ways that Edufocal has of making these lessons fun and interactive, and it may prove better for your own child. So there's some of this lost money I also do think is going to come back with, as we said, children, multiple children, those households, people who feel like, okay, let me go try it out. It's now going public. There's all of this marketing around it. So it's going to be very, very interesting to see.
And as we were mentioning earlier with the average revenue per user, so this is the breakdown here to show the number of paid users drastically falling from at the end of 2020, that's December, to September 2021. We moved from 48,000 to 60. However, we have an increase in revenue. Why? Average revenue per user increased by 3 times. Why? Because there's more things to do. The reality is, you won't have the same amount of spending on pep classes and and AML KYC training sessions by banks, and that is why I'm so interested in seeing how far the business side of things can go. The focal business has some very long legs to stretch, and evident here, they've already started to stretch those legs. As we go to more face to face, maybe the number of paid users may fall, um, especially as it relates to usage by PEP and persons for primary and secondary education. But the business side of things is where my eyes really are. Okay, so now on to the balance sheet. The balance sheet as at September 2021, that's 9 months, the financial year ends in December. Again, the focus of this video has primarily been on tying things back to the use of proceeds. Again, I just want to remind all the viewers to take the time out and read the entire prospectus. The entire prospectus. This is one of the ones that I've enjoyed reading more, because I think it was usually company prospectuses are very comprehensive and detailed, but this one in particular answered a lot of questions that I had initially before I even opened, hearing about the company and before I got a chance to look at it. So take a chance and read the entire prospectus. You get a lot of insight as to the breakdowns of all the line items, all the key changes, and what we have to see going forward. But again, we'll zoom in on the short term debt. So we see the movement from 10.7 million in 2020 to 63 million as at the end of the period in September 2021. And at that point in time, there were three loan facilities. Number one is a facility with Roots Financial Group. That one is the more interesting, and I'll allow Sean to talk about that one in a second. Then the other two are facilities. There's a revolving facility, well, it's a credit line with Carbine Capital Investments, and there's also a 4-month facility with Dollar Financial, and that one was penciled in September. So at at this point in time, we're now in February. So when we see the numbers for the period after the IPO is completed, we'll be expecting to see that short term loan non-existent. So Sean, go ahead about the Dollar Financial. All
All
right,
right,
let's
Dundas, I'm glad you passed this on. Because the Roots Financial Group has entered a loan agreement with Edufocal for $50 million. Now, as a part of that loan agreement, there was an option, which is pretty much just a financial instrument that says, if this thing happens, then we will do that, or then you are obligated to do that. So it's a if-then kind of contract. So this option clause said that in the event of an IPO, a portion of this loan would be convertible to ordinary shares. Should mean they no longer have to repay it, it's just convertible to ordinary shares. So that is the part that you see in the lender's option reserve pool, where we have 13.2 million shares that are reserved. They will be given to Roots Financial. In effect, writing off that amount of the loan, and then Roots will have these shares at a value worth $1, just like the rest of us who would subscribe. They would just get these shares, and Edufocal would not have to pay off that loan. But that's a very interesting arrangement because Kevin Donaldson, who owns Roots Financial, is on the board of Edufocal, and this transaction will give Roots Financial a 2% direct holding in Edufocal, which means nothing. For the most part, it just means that they're a larger shareholder than you and I would be if we. I mean, I don't know anybody's pocket, but then definitely I would be. I'm just saying. You know, but yeah, it's an interesting transaction, and what I really like about it is the fact that we have these kind of financial tools being utilized, and this is not the first, will not be the last that any of these types of financial instruments have been used. But I like to see them used because there is additional value that can be created through additional financial instruments. My friends know that I like derivatives. The complexity of finance makes no sense to me, but I understand it so well. So it's like, why do we make this thing so complex? But I understand the derivatives and those kind of things so well. So I mean, I like when we see these kind of other things happening. Options, we see there's a factoring agreement. One of their facilities is guaranteed by a factor agreement. So I mean, there's lots of little things that we have. We don't have any futures yet, or those kind of stuff. But I mean, it's positive stuff going forward.
So that conversion overall, as it relates to the clearing of the short term loans, I think which has been the main focus of this conversation, is so that conversion will leave 36.8 million from the 50 uh, of the facility from Roots, and then the other facility was a credit line, and then the other is the 4-month facility from Dollar that was at what 1.5% per week. That one was for 4 months. So that facility is likely to also be partially, if not completely, cleared by the proceeds of this IPO. So that's the breakdown there. Those three facilities are what the short-term loans are that will be cleared by the proceeds of this IPO. And you know that the capitalization of the company overall will be positively impacted since we'll be converting partially debt to equity, and then the rest will be cleared. So that's one good thing that I see on the balance sheet here. The increase in receivables and prepayment is something else that stands out because we mentioned earlier as we spoke about the financial year ended 2020, largely due to new contracts, and the receivables would naturally be higher as a result of the difficulties with schools being able to pay for arrangements with Edufocal as a result of closures due to COVID-19.
Yeah, on that receivables point, um, they made, I think they said their largest person who they were to collect from was the Ministry of Education. Personally, the ministry is good for it, giving them. I just don't know whether or not the ministry will adhere to the terms. So, if it's a 30 days thing, I don't know that at day 30 the ministry is going to give it. So, I mean, that is a figure that as long as this partnership that they have with the Ministry of Education exists, I anticipate there will be a large receivables component to at least that part of their business. Whatever results from the partnership with the Ministry of Education, I believe there will be a large receivables portion going into the future for however long it lasts, just based on the fact that it's a government client and those are not the most timely with payments. There are other ways they could seek to go through it, they're factoring, etc., etc. But I just believe there will always be a large receivables component to the government contract side of things. Dundas is not wrong in saying that schools also would have had difficulties, and so extending some leniency to get yourself some business as well as understanding the situation, you would have receivables growing from schools as well. But I do believe that the Ministry of Education part is going to be a large part of the receivables until that contract expires.
All right. So once again, this was just overview of things that jumped out at us in the financials, in the prospectus overall. Again, we want to urge all viewers to ensure that you read the entire prospectus because one, it's a very good practice overall. I have to make mention to another company recently IPO'd, Fesco. Fesco's prospectus was very comprehensive, and in the outline of the company's plans, you can see a direct relationship with what the company said they would do, what they have done, and the market's reaction to that. And I think Edufocal has done a prospectus that clearly outlines what the company wants to do, where the company sees itself going in a few years, and an intricate understanding of all of the company's operations and where they see themselves going would definitely equip you to make the right decisions as it relates to whether or not you should participate in this offer and what this company can do for Jamaica. Because I think it's way bigger than just a company coming to the market. I love it for more reasons than one. But again, I just want to implore everybody to read the entire prospectus. Usually you should, but if it's anyone, it's this one. Please read the entire prospectus. So
Yes.
so Sean, what do you think about overall though, the entire prospectus? Like what do you feel about it?
Um, Before we move into that, I just want to touch on one more key point that we didn't bring up across this entire thing. Edifocal maintains some preference shares. Um, for those who don't know, preference shares are very similar to ordinary shares, except they come with a fixed payment and no voting rights. So instead of getting dividends that may or may not fluctuate, and then you get to go to the AGM and give your opinion on what you think the company can do based on the AGM outline, the preference shares don't carry that. However, all of these preference shares that the company has issued come with a clause that they will be converted to ordinary shares using a formula disclosed in the prospectus in the event of an IPO. No, what this means is that there will be an additional 60.5 million ordinary shares based on the holders of the IPO and the conversion and the amount of ordinary shares that they will get after the IPO. There will be an additional 60.5 million shares that they are free to hold, trade, sell, buy more. They're free to do anything. But I think that was just a very, very interesting point with those preference shares. Regarding the prospectus as a whole, though, it's very interesting. I mean, I know I've been saying this on every listing since here, but I really, really like the listing and what it brings to the market. It's another different type of, I mean, we have iCreate, but Edufocal being a platform with technology where we're learning and the types of things that they're learning as well. They're doing business training as well as PEP. So you're having the actual school system and then you're having training to make people's professional lives better. iCreate is more for the creative side of our country. I don't know. I won't say. iCreate is more for creatives. But Edufocal, as you see, is more structured education where you have the PEP learning or the GSAT level learning and business things, which is new. And this new business line is very exciting. I know you love it, Dundas, but I actually think the education space has a lot of runway as well. I think there's many things you could do. You could partner with, look at us. Dundas and I both went to Wolmer's, for those who don't know. And Dundas, look at, I mean, Chippy, look how much Wolmer's you went to Chippy as an extra class teacher. You know, if Edufocal could link with teachers like that who have school systems or certain subjects on lock, and I don't know how you want to work out the revenue sharing or partnering, or maybe it's a licensing agreement, but if you could have their content codified and on your platform, that is another way to draw people. As we see, you could go up into CSEC level, you could go up into CAPE. There is potentials for partnering with tertiary institutions or tertiary level type of education, whether it not be a formal institution or anything like that. But there's many opportunities laying ahead for Edufocal, even just on that education side. And then this business side of things brings in a whole new perspective. My only gripe is that the offer is this small.
Yeah, same. I mean, it's a good and a bad thing. I mean, for well, as it relates to the company, I mean, it's just they're here now, so they can always raise after if they want to. You know, I would love to see if they. I mean, I'm kind of
Very true.
woeful that I likely won't be able to get much because of how small the float will be.
Give me a rights issue, Edufocal.
Please listen. Anyways, what differently? I feel like it's a very good offer. I wish it was bigger. I mean, for myself, but the company knows what it's doing, and they have their own plans for their capital. And this is just a start. They can raise capital when they want to. This listing, as I said before, is something that's new to the market. It's accurate, yeah, but no. It's the tech space, yeah, but the education training platform type of thing that I think has, as I said, has very long legs to stretch. On the education side of things, I agree that there's tertiary can go into, there are other types of certification can go into. But the reason that I'm more focused on the potential of the business side of things because of average revenue per user. That is the standout thing for me, because the average revenue per user naturally will be higher for businesses versus consumers. It are the people parents, and if it's the people parents, a college student, they will know how pockets they own their college. Now that's the reality, and facts. That's the reality of this kind of thing. Especially the business side of things, though. We mentioned the risks. What I would love to see is the focus on things that are mandatory. So I know that there's public passenger vehicle licensing. If it is a case that they have to do a course yearly, then that would be very good, because they have that arrangement already. I'm just not sure about how I know they have to renew licenses annually, but as it relates to the completion of a course, not 100% on that. But if that's the case, then that's a good case for the company's outlook. The other thing was the AML KYC offerings for financial institutions. There are many technical professions. Lawyers may need certifications or brushing up on certain things. Accountants, you name it. There is so much potential as it relates to sectors. So once the platform can manage, as again, we're in the super growth phase now. So once the platform is curated to a point where it can manage that level of expansion, then this company literally knows no bounds. There are no limits to what this company can do. The only drawback for me personally is the fact that the offer is so small. But
Agreed.
I'm not saying to participate or to not participate. Everything that has been said here in this video is just conversation between Schaunn and myself, things that we looked at. It is for educational purposes. We really just wanted some people to look at what we look at when we are looking at these things. Again, I'll implore everybody to look at the entire prospectus, because you need to understand this company properly to see how far it really can go. I mean, there are many things that we could say, but we want to stay far from the lines of advisory. And we just wanted to know that the information is there and it is easy to consume. In this particular perspective, it is very easy to consume. So, yeah.